In this video, we're going to talk about how to account for an asset retirement obligation, otherwise known as an ARO. And it first might be a good idea to start by talking about what an ARO is. So when you think of like some big manufacturing firm or something, sometimes they'll incur costs after they've created some asset. For example, some kind of nuclear facilities that they have to decommission. Sometimes you'll see that in the financial statements. There's some huge liability related to that. An oil rig that maybe they used it for a certain amount of time and it's no longer in use and they have to take it out of use. Closing a mine. So let's say they're mining ore and they have to close this mine. There are costs associated with these things. And we can even think of something like a landfill that has to be closed. So there are costs associated with these things. Obligations or liabilities that the firm incurs to shut these down, right? To retire these long-lived assets. So how do we account for these? Well, we can start by just saying at a conceptual level, we're going to record the fair value, of the ARO, right? What we think it's going to take to settle this, and we're going to capitalize it to the asset. Capitalized to asset. And now, what do I actually mean by that? Well, let's walk through some journal entries and an example, and it'll make it a little bit easier. So let's say in our example that you decide at your firm, you purchase a mine, and you decide that you're gonna mine for 3 years. So you're gonna close this mine, close in 3 years, let's say. And when you close, the costs, so you're going to have some costs to close this mine, right? You got to lock it up or something so kids can't get in there. You got to do something to shut this mine down, and let's say that those costs come out to be about $500,000. So now we've got to say, okay, well, how do we record a liability here? Because we have some kind of obligation, right? We have to close this mine when we're done with it. So if we don't record this somehow, if we don't account for that, then we're basically leaving out some really important information in our financial statements. So what we're going to do is we're going to say, okay, well, we've got this obligation of $500,000, but that's not for 3 years. So let's discount that back to the present. Now, if you don't know about the time value of money, I encourage you right now to check out one of the videos on the present value of a sum of money. But right now, I'll just suffice it to say, we'll calculate our present value using the following formula. We're going to have the amount that we're discounting, $500,000, over 1 plus our discount rate, which in this case, we'll say the discount rate is going to be 10%, so we'll say 0.10. 1 plus that, then to the number of periods. We raise it to a power, and this is the number of periods that we're discounting back. 3 years, 3 periods. So we've got 500,000 over, and this is 1.1 now here because we're adding in that 0.10, the 10% discount rate. So ultimately this can give us 500,000. I'll just break it down in one more step for you. The denominator is going to come out to be 1.331. And now when we actually do the division there, $375,657. Okay. So that's the present value of this obligation, discounting it back 3 years to the present of that $500,000. Okay, so how are we going to make these journal entries? Well, remember I said that we're going to capitalize this obligation. We're actually going to capitalize it to the asset itself, to the mine, right? So we're going to have some mine on our property, plant, and equipment, right, somewhere, but we're just going to have another journal entry to add to this mine the value of the capitalized value of this obligation. So let's have $375,657, which is the discounted value that's capitalized to the mine, right? Mine's an asset, we're debiting it. Then we're going to have a credit asset retirement obligation, right? This is a liability that we're accruing. Right? We say we can't ignore that we're going to have this liability in the future. Okay? But now, at the end of the year, we have to make some adjusting journal entries, right? Because now, remember, mine is an asset, right? Now, we've capitalized this amount, right? The asset retirement obligation amount, we've capitalized that to the asset account. So mine, like anything else, any other PP&E, is going to need to be depreciated, right? So December 31st, we're going to have depreciation. Let's just assume that we use straight line, so we just divide this by 3, right? So that's going to give us depreciation expense of $125,219. And then we'll have a credit, of course, to accumulated depreciation for the same amount. Right? This is just the depreciation of the capitalized amount of that ARO. But now we also have to account for something else. So, and again, this kind of comes back to this present value concept, right? We took this, now we've got this value that we recorded, that we capitalized. But actually, this is going to be the actual value that we think we have to pay out. So we need to account for the interest portion of that, right? And this again gets into the time value of money. I'm just going to write out the entry here, not go into an in-depth explanation. See the other video for that. We're going to have a debit to interest expense for $37,566. Now, how did I get that? Well, we take the 10% discount rate, right? Remember that 0.10? That's the discount rate we're using, and we multiply it by the amount of this ARO, or well, I should say the discounted ARO, right? We discounted it for a reason, and now we're reapplying that interest expense for the time value of money. So 10% times that $375,657, and then rounded, we're going to have interest expense of $37,566. And then what are we going to credit? We're going to credit the ARO. Okay. Now, ultimately, remember we started with the ARO was at $500,000, but we discounted it and we said, oh well, it's really only $375,657 in current day terms, right? But now, as we apply this 10% each period, we say, okay, well, we're going to take 10% of the balance and add it back. So now we're increasing that ARO by that amount. Ultimately, at the end of 3 years, right, when everything is all said and done, if we were looking at a T account, the ARO would then be at $500,000, right? So we're starting at $375,657, the discounted value, and we're adding in this interest, right? It's increasing the ARO until we get to the $500,000 at the end of year 3. So now let's fast forward. So now again, each period, so like December 31st, 2018, we're just going to have the same thing. We're going to record depreciation, we're going to record the interest again, and increase the ARO again until we get to the $500,000. But, so that's just kind of not going to be the exact same entry again for the interest expense and so forth. But again, let me just skip to what's going to happen when we actually settle this ARO. Now, when I say we settle it, we'll call it settlement now. When we settle this, that's we're actually paying some other firm, or we ourselves are actually closing this mine. We're closing the mine, and we're retiring this asset, right? The ARO is no longer like a liability. We're actually going in and shutting the mine down and incurring whatever costs we're settling it. So what entry did we make then? So let's just say that we settle on, let's say it's February 1st, 2019. We decide to settle the ARO, and let's say it costs us only $480,000. Now, we had estimated $500,000, but it's $480,000. So there's a $20,000 difference there, which I'll show you how we account for in a minute. But first off, remember, our ARO, after adding in all the interest each period, ultimately got us up to $500,000, right? Which is what we estimated. So we're going to debit, to take this off the books, the ARO for $500,000. It's going to be debited. Right now, we no longer have that asset retirement obligation because we've settled it, right? So now what do we credit? Well, we're going to have to pay some cash to close this mine, right? So whether we pay cash to some firm that does it for us or whether we actually do it, we're paying out cash of $480,000 to shut down this mine, right? We thought it would be $500,000, but it was actually $480,000. So what do we have here? Well, we have a gain. We have a gain on settlement of ARO. It's gain on ARO. and that's just $20,000 to make this entry balance, right? So now at this point in time, at February 1st, 2019, if we were to look at that T account for ARO, it would be zeroed out. Why is that? Because we no longer have an obligation to retire the asset. We've settled it, we've taken care of it, we recorded our ARO, we accounted for the present value. Over time, the interest accumulated in the ARO account until it got to $500,000. Now we take that $500,000, we back it out, the ARO goes to zero, and we have no obligation because we've paid this cash to shut down the mine.